Well, welcome to our Chapter 10 lecture. I'm looking at the book and I'm looking at page 448 is where we'll start. And we're going to start out this by measuring long-term liabilities. That's mostly what this chapter is about, is long-term liabilities and bonds. Before we get too far into that, though, we should talk about present values and the concept of present values. And they start to talk about this in your book on page 448. And just the concept that money grows over time. If we invest it, we get a rate of return. That money today is worth more in the future. And so in the example they've given us here, they're saying the value of a dollar today to be received or paid in the future at a specific interest rate is worth a different number a year from now. So basically, if I want to think of it this way, if I want $100 a year from now, if I invested $90.91 and earned 10% on it, in a year it'd be worth $100. Okay, so that's what they mean by the present value of the $100 received in 1 year. And of course, the variables there are the interest rate and the number of periods. Those would be a couple of the things that we'll have to compute if we're doing this on a calculator or in Excel. And so with present value and future value, it works the same way. And they show us both of these on page 448. And so, excuse me, so the future value of $100 is $90.91 today. That's one way to think about it. Or the present value of $100 to be received in a year is $90.91 today. So either way, you know that $100 a year from now is not worth as much today because of interest. If I have a smaller amount today, and if I put that aside and receive a certain return on that, it's worth more in the future. And so that brings us to the concept of present value tables. Okay, and calculating present value can be done a couple different ways. We can use tables like you see here, and those tables are certainly in the book also. Also in the book, they show you the calculations, or the keystrokes, I should say, to use your financial calculator. If you want to use a financial calculator, I would not run out and buy one by any means. Don't do that. But many smartphones have them. My iPhone, the calculator app, if you turn your phone sideways, turns into a business calculator. So that's a thought. If you have a smartphone, you can easily, I would have to think it's already on your phone somewhere for free, get a business calculator app. You can also, of course, you can find this on many websites, but I've also given you an Excel file. It's in my handouts, and I'll do a separate recording just to show that to everybody also. So you've got a couple different ways to calculate present values. A table, a financial calculator, or Excel would kind of be your main three ways. And so you can see here that with using the previous example of 10% and 1 year, or one accounting period, I used a present value table or factor of 0.9091 multiplied by my $100, which gave me a present value of $90.91. Here's a future value table. So you've got present value tables and future value tables. And the future value table, you can see it's still one period at 10%, but the factor is different. It's 1.1. Okay, so we're saying if I multiplied $90.91 times 1.1, it will grow into $100 a year from now. Okay, that's what they're saying with this one. Which brings us to the concept of annuities. And an annuity is a series of regular payments. Okay, payments that happen continuously with the same dollar amount period after period. Okay, a series of equal amounts to be received or paid at the end of equal time periods. Okay, and so we can do a present value of that future stream of payments. Okay, and so to do that, of course, we'll need a different table. The previous two tables, if you saw them, they were numbered. They were numbered tables. This is table 1, the present value table, and the future value table was table 3. And so then we're going to have some annuity tables, tables 2 and tables 4. And the present value or future values can be computed for a series of regular payments. So it'd be the same dollar amount over a number of years. and applying some kind of a factor, of course, an interest rate factor, will then give us a multiple to apply. And then that would help us to calculate the future value or the present value of those cash flows. And they start to talk about this concept on page 452 and also on 453. And again, they show you the keystrokes you can use to do this in a financial calculator. They also will then show you on page 453 how to compute an Excel formula to do the same thing in Excel. And again, I have an Excel file that will help you to do that also. But you will see that on page 453 or 454 is where most of that's at. Okay, so that brings us to the concept of notes payable. Now this chapter is about long-term financing. And so a long-term note payable, a mortgage, and a bond, those are kind of the biggies that we're going to look at today. And a note payable then is long-term debt. It's paid back at the end of the loan period. Interest is usually paid throughout the loan period, but then there's a lump sum payment to pay the principal whenever the note ends or expires. And this is, they're starting to show this information to us on page 456 and 457 if you want to turn there before you look at it. I also left out the concept of leasing earlier too. So notes payable, mortgages payable, leasing, and bonds are all the different kinds of long-term financing that we'll look at today. And so you can see here a journal entry for to record a loan from a bank. It says a 2-year loan, 10%. And if the bank gives us $10,000, obviously we will debit cash for $10,000, and then we would credit notes payable for $10,000. Okay. After 1 year, we need to record interest expense. Obviously, interest is incurred due to the passage of time. So every day this loan is outstanding, we are incurring interest. After 1 year, we can record easily 1 year's worth of interest, and you can see they came up with $1,000. That's just simply taking 10% times 10,000 and then times 1 for 1 year, and that gives me $1,000. Okay, so 10% of 10,000 is 1,000. So the interest expense after 1 year is 1,000. So we'll debit interest expense, credit cash. And then after the second year, we're going to pay the loan back. And so we'll debit notes payable to show the fact that we've paid off the principal. We'll debit interest expense for the next year's worth of interest. And we'll write a check for $11,000, credit cash for $11,000. Those same entries that you see right there are in your book on page 457. So the next concept then is the concept of a mortgage. And I think most of us probably know what a mortgage is. It's a long-term loan with an asset behind it, typically a building or land, that serves as collateral to the loan. And they show us some examples of mortgages on page 458. They show us some journal entries. They show us some tables when it comes to calculating an amortization schedule. They also show us one on page 459. Okay. So it's a written promise to pay a stated amount of money secured by an asset, typically building or a land, and the liability on the balance sheet is the amount borrowed, okay, which is also the present value of all future payments. Okay, so in this example they're showing us here, a company took out a 30-year, $100,000 mortgage with monthly payments. The interest rate's 8%. Monthly payments are calculated to be $733.76. And so the initial mortgage, when we take it out, we receive the cash from the bank, which you would then use to buy an asset, probably a building on some land, debit cash, credit, mortgages payable for the $100,000. And then, of course, we'll start to make payments on a monthly basis. And with each payment, there's both an interest component and a principal component. Part of each mortgage payment pays off interest due, and part of the payment reduces principal on what's due. Okay, A schedule can be prepared showing the portions of each payment that are principal and interest, and that's exactly what they're showing us on page 459. Each payment then, of course, you can calculate the payment by using a financial calculator, and you can then figure out from that payment how much goes to principal, how much goes to interest, and see how much goes to interest initially, right? When you first take out a mortgage, your first payments are almost entirely paying off interest, and a little bit goes to principal. But then that changes over time where more of your payments are going to principal and less is going to interest. Okay, but that's what they call the effective method of doing this, is that each payment, how much goes to principal and how much goes to interest, changes just a little bit. You can see it doesn't change a lot, a few cents, but it does change over time. Okay, and so to record the journal entry, it's just a matter of pulling out our mortgage table. Of course, we know we have to credit cash every month for the same amount, $733.76. The question each month is how much goes to principal and how much goes to interest expense. And so you can see here we're debiting interest expense based completely on the fact that this is our fifth payment, and you can see how much we dedicate to interest versus the mortgage payable. Next is the concept of leases, of leasing an asset. And this information is on page 460, and of course a number of things can be leased. Almost any kind of an asset can be leased. Vehicles, equipment, obviously office space, retail space can be leased. And there's different kinds of leases. We'll talk about a few different kinds of leases here. And a lease really is an asset obligation report on the balance sheet at the present value of future lease payments. And then we have a yearly interest expense based on how much lease liability balance that there is. And so it works a lot like a mortgage. And we initially, you can see here the initial journal entry, the one at the top, is we're debiting leased equipment. And then we're crediting lease liability. You can lease an asset and effectively own it. And so that's basically what we're doing here, is we're putting on the balance sheet as an asset. We're also putting on the balance sheet a liability, which is the present value of all future lease payments. Okay, and we're going to make lease payments of $10,000 a year using an interest rate of 14% to compute how much is paid each year. And so with each payment, we know then that a certain amount of the payment must go to interest expense, and a certain amount goes off to paying the principal, the lease liability. And you can see how they calculated that at the bottom of the journal entry to record interest expense in first $10,000 payment. Interest expense is 14% of the $52,161, which is $7,303, and so what's left over equals the principal payment, because we know we're writing a check for $10,000. So it's a credit to cash for 10, debit interest expense for 7,303, and then we debit liability for the difference. So make sure you read through some of that information on pages 460 and 461. You'll see a schedule of lease payments on the bottom of 461, very similar to a mortgage amortization schedule. They're almost the same thing. Also be aware of what an operating lease is, and they show us operating leases on page 462. An operating lease does not show on the balance sheet. Okay, with a capital lease, which is really what we looked at on pages 460 and 461, a capital lease really gives you ownership of the asset. Okay, an operating lease just gives you the right to use an asset for a certain amount of time, and then you give the asset back. You're basically renting it, more or less. And if you think of an apartment unit in an apartment building, that's typically an operating lease. When you rent out that property, you sign a lease. You've got the right to live there and occupy that for 6 months, a year, whatever your lease term is. And whenever your lease expires, you don't own the apartment, right? You're just giving it up, and the next person will then, of course, take over. So think of it that way. It's really an operating lease is more of a rental where we never take ownership of the asset. We're simply using the asset, and the owner keeps ownership rights and maintains ownership rights. Okay, the next concept is bonds. And bonds is a very popular um, way that businesses um, finance operations. It's a way that corporations in particular and governments both raise money for projects, for expansion, whatever it is. And there's lots of terminology when it comes to bonds. And this terminology is on page 464, just full of terms on that page. There's an inset to that page. Be sure to read through all that terminology. Same with 465, there's some terminology there. There's different kinds of bonds also listed for us on page 464. Be sure you know those terms. I will quiz you on those. The test for these chapters will include some of that terminology. So be sure you're aware of those terms. Review them before you take a quiz or a test. And so a bond is really a contract. It's between a borrower, which is the issuer of the bond, and a lender, which is the investor. And so the investor is somebody who buys the bond from the bond issuer, which is typically a corporation or a government. Okay, and then what happens is interest payments are made, typically twice a year. It can be once a year, and then the principal is repaid whenever the term of the bond expires. It could be 5 years, 10 years, 30 years, whatever the corporation or the government wanted to do when they issued the bonds. And so there are many types of bonds. A debenture bond has no underlying asset pledged as collateral. Basically, you're going on the good name of a corporation that issues a debenture bond. A secured bond has some kind of a asset pledged to protect lenders if the corporation that issues the bond goes bankrupt. Some asset has been held aside, set aside, given to a trustee to oversee. A registered bond is when an issuing company keeps a record of the names of bondholders, and anybody who is on that registry then, of course, receives interest payments. A coupon bond is a company not keeping record of who owns the bonds. Instead, whoever does own the bonds sends a coupon into the company, and that coupon then says, "You owe me interest," and then a check will be sent to the coupon holder for interest payments. So coupon bonds versus registered bonds. Nowadays, most bonds are registered. Some additional bond terms, and again, these are almost entirely on page 464. A term bond, a bond that matures in one single sum on some future specified date. So a corporation can issue term bonds like a 30-year term bond, and the entire amount is due in 30 years. Or you can have serial bonds where you would issue bonds that mature in a series of installments. Some would issue in 5 years, or mature in 5 years, or 10 years, or 15 years, and so on. It's really what the issuer wants to do. A callable bond is a bond that can be redeemed anytime at a specific price. So the bond issuer issues that bond, and they have a right to call it back whenever they want to call it back. Typically at a price higher than what they sold it for, though, is typically how those work. A zero coupon bond is a bond issued with no promise of payment. Instead, basically, they're sold at a deep discount, and then principal and interest is paid all at once when the bond matures. A junk bond is a high risk bond issued by a company with a lot of outstanding debt or in a weakened financial position. So whoever buys that bond is taking on significant risk that the money lent will never be paid back, the risk that interest will not be received, and so on also. Okay, so junk bonds or riskier bonds. Some characteristics of bonds, they have a face value or maturity value, usually issued in $1,000 increments. The principal amount that will be repaid at maturity is the face value or maturity value, means the same thing. The stated rate of interest is the amount of interest that the company will pay. It's typically stated on the bond contract itself. That's why they call it stated rate. So when a bond is issued, it's issued for a stated rate of interest. Now there's also the market rate of interest, and that is what the market will pay for a bond of that type. Market rates of interest change daily, and so almost always the market rate of interest will be different than the stated rate of interest. It's very rare that they'll be the same. Almost always they're different, just because the market rate of interest changes all the time. In the news lately, you've been hearing a lot probably about mortgages and mortgage interest rates. They're pretty close to all-time lows right now because of the fact that we have the market right now is just saying interest rates need to be low. The government is keeping policies in place to keep interest rates low to make it easier when people borrow money so they don't have to pay as much interest back, and kind of jumpstart the economy, some things like that. Okay, so a bond issuance. How do we handle a bond issuance? This begins on the bottom of 465 and is mostly on page 466, so be aware of that. The bond's face value in future interest payments, face value times the stated rate of interest, are discounted by the market rate of interest to arrive at an issuance price. So when a bond is sold, the market rate of interest is used to determine bond price. Okay, not the stated rate, the market rate. If the stated rate of interest is less than the market rate of interest, the bond will be issued at a discount. Okay, so the stated rate, let's say the stated rate, remember that's the rate printed on the contract. Let's say that's 5%. Okay, but the market, let's say the market pays 6%. Okay, so stated rate was 5 and market was 6. My bond is not very attractive. If I'm a corporation trying to sell this bond, it's not an attractive bond because investors can go and buy a similar bond from somebody else and get a 6% rate of return. Why would they buy my bond at 5%? Well, they're willing to buy my bond, but they're not going to pay me the full face amount or stated amount of my bond. They're going to pay me less. So if I'm selling a $10,000 bond and I'm paying a 5% rate of interest when the market pays 6, I'm not going to receive $10,000. I'm going to receive an amount lower than that. Okay. So the bottom bullet point is the flip of that, basically the inverse, where the stated rate of interest is more than the market rate of interest. The bond is issued at a premium. So if I flip that 6 and that 5 around and said, if the market's 5% and my rate on my bond, my stated rate is 6%, now my bond's very attractive, right? It's paying more than the market, and so investors are willing to pay me more than what my bond is worth. So if my bond has a face value of $10,000, I would expect to receive more than $10,000 for my bond. Excuse me. Here's some examples of that, and these examples you will begin to see them on page 466, 467 is where you'll see them, also on 468. So be sure to look through some of those. They will also show you some of the keystrokes that you would use on a financial calculator to calculate these. So say your company issues a $100,000 5-year bond with a stated rate of interest of 10. If the effective rate or market rate of interest is also 10, it's real simple. Okay, very, very easy. It says here the semi-annual interest payment will be $5,000, and I want you to think of principal times interest times time. Okay, remember principal is $100,000. The stated rate of interest is 10%, which is all the same as the market, times time, and basically this says semi-annual. That means twice per year. Okay, so every 6 months. So if you took principal of 100,000 times 10%, 0.1, times 6 over 12 to represent 6 months, that would give you the $5,000. So every 6 months, interest will be paid of $5,000. Okay. We then also compute the present value of all those interest payments twice a year. It's a 5-year bond, so there's going to be 10 payments. So 10 payments of 1 at 5% using table 3 gives you a factor of 7.7217 multiplied by the 5,000 gives you 38,609. Okay. So the present value of all of the interest payments is 38,609. And then we have the maturity value of the bond. The Sayre company is issuing this bond, and what they're saying is to whoever buys the bond, we're going to pay you interest of $5,000 every 6 months, and then in 5 years we're going to write you a check for $100,000. Okay, so if I buy that bond, if I'm the only person who buys that bond from them, and I write them a check for $100,000 because the market rate and stated rate are the same, so I'm going to pay $100,000 for this bond. Every 6 months they're going to give me $5,000, and then in 5 years I'm going to receive that $100,000 back. So I'm basically lending them money, and they're making interest payments to me, and then of course paying off the principal in one lump sum. And so the present value of that one lump sum, the $100,000, in 10 periods, because it's 2 times a year for 5 years, so we're just keeping to use that 10 periods, but notice that we're using 5%. If I use 10 periods, I have to use half the interest rate. Okay, so 10 periods, 5. And that gives me this factor here. 61,391 is the present value of the $100,000 to be paid in 5 years. Okay, the present value of all the interest payments is 38,609. So together that's $100,000. Okay, and so because it's $100,000, because the stated rate and the market rate are both 10%. Okay, so what happens then if those numbers change? Okay, so Sayre Company issues the same bond, $100,000, still 5 years, still stated rate of 10%. But what's different now is that the effective rate is 12%. Okay, so the effective rate is higher where the market rate. Okay, so the effective rate and the market rate are the same. So what we're saying here is that investors can go to the open market and buy a similar bond and get 12%. Okay, so right away we should be thinking our bond will sell at a discount because we know that investors can get a better rate somewhere else. They're not willing to pay us full value for our bond, and they won't do that. And so because of that, we take that same 5,000, we multiply it by this factor here, and it's a different factor now because now we're using half of 6% because it's 10 payments. Twice per year for 5 years is 10 payments. And so we have to use half the interest rate. Half of 12 is 6. And we get 36,800 is the present value of all of the interest payments. And then the present value of the $100,000 principal payment is 55,840. So together those two equal 92,640. So when I sell this bond as Sayre Corporation, I would expect to receive a check for 92,640. Okay, so if I issue my bonds at face value, the journal entries are pretty simple. I'll debit cash, credit bond payable for 100,000. Every 6 months I'm going to make an interest payment. I'll debit interest expense for 5. I'll credit cash for 5. And again, that was simply the principal of 100,000 times 10%, 0.1, times 6 over 12. Then as we retire the bond, when we pay the principal of the bond back, basically in 5 years, we then write a check, we debit bond payable, credit cash, and the bond is paid off. Now, bonds can be retired early, and sometimes bonds are callable, where when the bond is sold, there's a call provision in the contract that says the bond issuer has the right to buy those bonds early, typically at a price higher than what they were sold for, though, to protect the investor. Investors are basically saying, we'll buy your callable bond, but we want to be protected, so if you call it back from us, we want to get a return on our investment. And so typically that's what you'll see here is that we'll get a higher amount like this at 105 means, think of it as 1.05. I should also tell you that there's some sample journal entries for selling bonds and paying interest and all that on page 469 and 470. Just want to make sure you're aware of those and take a look at those. Also be aware that you can retire a bond early, just like we said, and the same entry that you see here is on the top of page 471. And so that 105 means we have to pay the bondholders a little bit extra to get the bonds back from them. And so we're debiting the bond payable for the full 100,000 that we owe, and then we debit loss on bond retirement for that extra 5,000. Okay, when you see that 105, think of that as 1.05. Multiply that by the bonds payable number of 100,000, and you get 105, obviously. And anything above 100,000 is our loss. And so we're losing 5,000 by paying these bonds off early. Okay, why do companies do that? They actually put call provisions in to protect themselves against interest rates. If interest rates change significantly, basically if they were to go down, it might make more sense to call those bonds back and then reissue a new bond issue at lower interest rate. And even though we lost 5,000 calling them back, if interest rates go down enough, most likely we would save enough money in the future that we would more than get that money back. When it comes to looking at financing, of course, there's always some ratios to be thinking about that will help us analyze our debt, and some financial ratios regarding debt, and these are on pages 472 and 473. And you can see here that we have the debt ratio, which is total liabilities divided by total assets, which tells us how many of the assets the corporation has were financed with debt. We then have the debt to equity ratio, which is the number of dollars of debt for every dollar invested by a stockholder. We're taking total liabilities, which is total debt, and dividing that by equity. So how much liability do we have in relation to equity? Times interest earned is a corporation's ability to repay interest. And the higher this number, generally the better. The ratio of income available for interest payments. And so we look at earnings before interest is paid and before taxes is paid, and we divide that by our interest expense, and that gives me a multiple of earnings higher than interest expense. Okay, and it's basically the cushion we have to cover interest expense. And so the higher this number is, the better. Okay, what if bonds are issued at a discount or a premium? The journal entries we looked at earlier were for bonds issued at market value, where market rate and stated rate were the same. But what would be more common is when bonds are issued at either a discount or a premium. And so no matter what we receive for a bond, if in the top one we have the discount example, we still credit bonds payable for the full 100,000, because that's what we have to pay back. We still have to pay $100,000 back to the bondholder, even if we only receive cash of $92,640. And so we have what we call a discount on bonds payable, which is the difference. We'll have to amortize that $7,360 away. Over the life of the bond, we'll have to reduce that. Then we have bonds issued at a premium. Okay, and again, even though my bond payable is $100,000, and that's what I'll have to pay back. But in this example, I received more than that. I received cash of $108,114, but I only have to pay back the $100,000. And again, either way, if we have discount or if we have premium, we have to amortize each over the life of the bond. Okay, it's amortized over the life of the bond, so the value of the bond is equal to face value at maturity. Okay, so in the example we were looking at it with a 5-year bond with payments twice a year, with every interest payment there has to be some kind of an amortization number to go with it. Okay, so we'll divide the discount or premium by the number of interest periods and recognize that amount as extra expense for discount or less interest expense for premiums. Remember that for discount, I only received $92,000 and some dollars, but I have to pay back $100,000. So that $7,000 difference is extra interest expense recognized with every interest payment. And the flip side was the premium where I received $108,000, even though my bond is worth $100,000. So I only have to pay back $100,000. So that extra $8,000 reduces my interest expense over the life of the bond. And so with every interest payment, that will reduce my interest expense. And then here are the journal entries or associated with that. Here's the discount journal entry, and this is on the bottom of page, you'll see it a little bit on pages 474 and 475 is where they show us this. And excuse me, 474, 475, and even 476. You'll see it on all those pages. And so all I did was take the discount divided by 10 interest payments, and then every single interest payment is just like you see here. So we're going to make 10 interest payments on this bond. Every single payment will debit interest expense for 5736, credit discount for 736, and credit cash for 5000. The cash that we pay is based on the stated rate of interest, but the interest expense is based on the market rate of interest, okay, with the discount on bonds handling the difference. And of course, the same thing would apply to a premium, which we'll get to here soon. Now, that's the straight line method, so that journal entry stays the same for every single interest payment. But we also have something called the effective interest amortization method. And that's amortizing a varying amount of discount or premium each period. This works much more like a mortgage, okay? And the interest actually incurred in the bond is the bond carrying value multiplied by the effective rate of interest. And so they've got a schedule. It's on page 478 that shows you that information. And it works just like a mortgage, where every single interest payment, the cash we pay is the same. In the example they show you on page 478, it's $6,000. But what changes every month is how much goes to interest expense versus how much goes to amortization. And they got something like it, just like it right here. Okay, and so in our example, every single month that we make a payment, you can see it changes just slightly. The amount of principal versus, or I shouldn't say principal, the amortization of premium or discount versus how much is recorded as interest expense. The Excel file that I put in handouts, I'm going to do a separate recording about that. I'm going to show you kind of how that works on that one. So here is the example of the premium retirement of bonds with a discount or premium. Retirement at maturity is the same as face value because we have to amortize that premium away. And so here is my journal entry to record premium. Retirement, I'm going to debit, in this example, what they're doing is they're retiring the bonds with a discount or a premium. And so after 2 years, which is after 4 payments, they're going to call the bonds back. And remember that they're going to pay that 105, so I have to pay an extra $5,000 to get these bonds back. And so we're going to credit bonds or credit cash for 105, debit bonds payable for the 100,000. We then have to debit any premium that's left to get it off the books, and the difference just simply goes to gain. In this example, we have a small gain. Of course, we could have a loss like we had earlier. So basically that gain or loss is just basically a balancing entry, what it takes to make it balance. Okay, that's it for Chapter 10. There will be a separate recording though, won't be very long. I'm going to show you an Excel file that you can use to help you also calculate some of the present value and future value numbers.